We've seen 6 weeks of gains for US equities. We're 15 days away now from the US election. What do you believe markets are attempting to price in here? Are they attempting to price a Trump victory or just rallying through the noise?
I think of late, right, it's very hard to remodel a portfolio on the back of an election outcome, Dan, because you might be expecting that a certain sector, a certain asset class will actually benefit, but it doesn't necessarily translate into earnings and policies later on, right? You've seen this in classic example was 2016 election. Look at the industrials back then. The market priced in a huge infrastructural change in spending, and the industrials actually peaked on a relative basis just 2 weeks before the election. So it's a kind of buy the rumor, sell the news kind of a thing. Overall, I think bond market will be driven by fiscal policies and expansions. It's very key. I mean, irrespective of who chairs the White House, none of the candidates are going to be fiscally positive. But I think bond market will be looking into the policies of fiscal, while FX market will be tuned into the tariff policies. Overall, it's going to be exciting between now and the election date.
Yeah, I think you've got it exactly right, Aarthi. And look, walk me through what we're seeing in the fixed income space right now, because the 10-year Treasury is back above that 4% level, or at least flirting with it. Do you think that's fairly priced in this environment as we look towards not just the US elections here, but of course a really busy earnings season as well, and the Fed in focus too?
I think given the current landscape, Dan, market is factoring a kind of a no landing scenario, right? No major deterioration in the job market, GDP, Atlanta Fed GDP galloping at 3%, inflation is sticky. All of this actually points out that 10 years is actually rightly priced. I don't see a reason why it should be below 4%. And even if you were to assume that long-term inflation will settle at 2.5%, neutral rates would be between 3 and 3.25%. 10 years has to be around 4% because it has to re-establish a term premium. Bond investors have recently figured out you can lose 15 to 20% on 10 years over a year. So they want their term premium back, especially in an environment where there's going to be a high amount of supply coming in.